key themes for the half year 2014 reporting season was that for the first time in quite a while, we saw expectations met for the half year, but also the forward expectations not being downgraded. So it was one of the more interesting half year reporting seasons that we've had for the last few years. And there was quite a lot going on within the actual sectors, the companies themselves. And we saw some quite surprising moves in stock prices post the company's reports. The resources sector results, we saw some pretty good numbers come out of particularly BHP and Rio as they benefited from the higher iron ore prices over the 6-month period. So good numbers there, but obviously that got totally swamped post their results by the quite dramatic fall in the iron ore price. So we've seen those stocks under pressure, and that's starting to provide some potentially some interesting opportunities there. The second tier, third tier mining companies, we could really see how they've struggled with both declining commodity prices and rising costs. So they've certainly been under a lot of pressure. Our focus sort of really remains that top tier, the BHP, Rio companies in that space. Some of the strongest results came from those companies that were expected to do so. The high valuation, the high growth companies, and I'm thinking about the Seek, the realestate.com, Computershare, some quite good results, and these companies got rewarded in the market post that. So the high value companies, high growth delivered. What was also very interesting in the season was that we saw those companies that had very low expectations, things like a Fairfax, for example, where expectations were quite low, but we saw a reasonable result, better than expected, and we saw some very strong aftermarket performance in some of those things. So it was a real trend back to the median for a lot of companies. We think the market is much more closer to being expensive than cheap at the moment. We've had some great gains over the last 2 years. So the All Industrials Index is trading on a forward PE for 2015 of about 16.5 times, versus a long run average of 14. And we still need some profit growth to get us to that 16.5 times. The latest reporting season was quite encouraging in the sense that we may ultimately get that profit growth. But I think we just need a period of catch up where earnings need to catch up to the share prices. As we've rolled out of the reporting season, we've rolled back into the IPO frenzy that we saw at the back half of 2013. So the pipeline continues to fill up, obviously of varying quality, and the key rule is obviously to take every company on its merit. So in the next few weeks, months, we're going to see companies such as Mantra, who are a hotel operator. We're seeing Aussale, internet retailer, Japara, aged care business. So quite an eclectic mix. I guess the key theme is that most of these businesses are coming out of private equity. The key thing for us about that is to make sure that the businesses haven't been just run very hard in the short term to achieve a profit outcome, that they've actually, the numbers, the profits are sustainable on a medium-term basis. Our outlook for the remainder of 2014 is pretty sanguine in the sense that we've come off some very good years, 20% per annum the last 2 years total return for the market. We think it's hard for the market to keep going with that. We really need to see some catch up in terms of earnings growth come into the market, into stock prices. So we think a much more subdued outlook is on the cards. That said, where there's still pockets of value and particularly dividend yield that we think will be delivered, and given the alternatives, term deposit rates, etc., there's still, the equity market is still not a bad place to be. But I think expectations of large capital gains going forward, might have to be tempered.